Time to talk personal finance now, thanks to our partners at Forysth Barr. Tariffs on, tariffs off. It's a bit unclear what's coming out of the trade policy from the White House over the last wee while. Volatility, recession fears, you name it. So how should you look to invest during a time like this? Well, Mark Richardson is your man, investment advisor at Forysth Barr, is with us this morning. Mark, good morning.
Yeah, morning. Morning, Ryan. How are you doing?
Yeah, good, thank you. So should you wait and hold cash? What should people do?
Yeah, it's interesting, isn't it? And we had Wallace, our macroeconomics person, the other day, talk about markets have been behaving somewhat over the last wee while. But then when you think about it, I think there's a fair bit to go yet. And there's only really been one deal done. That was with the UK. Everything else is on hold. So there is still a fair amount of uncertainty. Markets don't like that uncertainty. But look, there's probably more people who have lost money not investing than investing. The point is, you can sit on the sidelines in cash. You probably won't go backwards, but you won't be going forwards, even if you're making, say, 3% on that money. You need to be in the game. If you're in the game, you might get some muddy knees, but you got a chance of scoring a goal, haven't you?
I saw this week that there's something like $21 billion in funds maturing and investments maturing out of term deposits over the next 6 months. So a lot of people are at times like this going, what do I do? Where should I put it?
Well, there's a number of different strategies. You could just sit on the sidelines in cash. You could maybe go and get yourself a well-diversified managed fund, put it all in and hide under the bed for three to 5 years, and you'll probably be all right at the end of those 3 to 5 years because, once again, the old cliche, time in the market. And, markets have survived famine and political regimes and war and depression and recession, and they'll survive Trump. You could trickle the money in over time on what's called dollar cost averaging. So that tends to smooth so you don't worry about where the markets are when you enter, up here, down here, wherever. That tends to smooth your entry point in. Or really, if you're going to be very risk aware at the moment, then you've got to diversify. And I know that's another cliche, but diversification is the only maybe safety in investing. And that's not about just having lots of shares, let's say. It's about the type of shares and the asset allocation. So how much bonds and cash do you hold and property stocks do you hold as opposed to how many equities and shares and what countries they come from and what those types of businesses are. And do they all go up together? Do they go down together? Or is there some sort of negative correlation? It's about the type of diversification that you have.
Is there like a formula you should have 30% this, 30% that? I mean, or is it just different for everyone? Is there a general rule of thumb?
Yeah, you're talking about asset allocation now.
Well, here we go.
Yeah. So it will depend on the time you have to invest. It depends on how comfortable you are with volatility. So let's say you're a bit more comfortable with the volatility. You've got longer to invest. You're not going to judge it after a couple of months to a year. If that's the case, then you could have more shares, more equities, and what we'd call a sort of a growth profile. If you're a bit more conservative, if you need the money in a shorter period of time, if you're a little bit older, if you're investing for income, you might have what's called a more conservative asset allocation, and that is more bonds and more cash. And then you've got to think about how you're doing it. Are you doing that via, let's say, managed funds, where you have a fund manager who's doing all the hard work and deciding what the underlying assets are, or are you doing it in what we call direct investment, where you're going out and you're picking the individual stocks and individual bonds? But you've got to make sure that mix of different securities is right. And then you look at the equities and the shares you're buying. It's no good having lots of tech stocks.
No.
Because they all go up together, they all go down together. So you've got to mix it up a little bit.
Yeah, absolutely. Good to see you, Mark. Thanks for coming in.
No, my pleasure. Next week.
That is Mark Richardson, investment advisor at Forysth Barr. It is just gone 8 o'clock. You're watching Herald now.